Welcome to a Wiser Retirement Podcast. We put together a guide with some recommendations to help you focus on being financially fit at different milestones in your life. Some of you may be ahead of schedule, while others may have to play catch up. You can download this guide for free on our website. The link to download Your Path to a Lifetime of Financial Success is listed in the episode description. Or you can go to wiserinvestor.com, scroll to the bottom, and find it there. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
So today we're going to talk about how financial planning should look different during each decade of your life. That is the theme for the quarter. And to be real honest with you, when we sit around the table and we plan this stuff, this one's popped up a couple of times and it's gotten shelved. And we were convinced to take this approach this quarter. But, I'm really excited about it, actually. We have this white paper you can download starting today. It's called Your Path to a Lifetime of Financial Success. And I think through the planning process, a question that will often come up, not every time, but often comes up, says, well, where am I compared to people my age? And I always kind of smile and I'm like, well, if you look at the statistics, the fact that you're sitting in a wealth management firm means you're probably
if you're thinking about it,
95% ahead of everybody else,
yeah,
right?
Yeah.
But it's a realistic question. I mean, when you do your tax return, a lot of the software and some CPAs will actually give you, based on your age and demographics, everything. This is what you make versus other people across the country. Which I don't know. I don't know why people really get that worked up over.
We talk a little bit about, how much we make versus how much we have, and in a lot of different podcasts that we've had.
Yeah.
And it's really not about what you make. It's about what you can keep.
What you save.
That's right.
Yeah.
So
I'm trying to convince this to my kids right now. It's just like, there's so many rich people, and my 10-year-old hasn't quite grasped the concept yet, but my older one's starting to get it. Yeah. I was like, yeah, man, there's a lot of fast cars around town. There's a lot of big homes. And some people are very fortunate. They get to be rich and wealthy, but there's a huge difference. Wealthy people don't even have to have a lot of money. They just have to be able to have the freedom to do what they want to do. And to me, that's wealthy. You know,
being able to set your own course, your own destiny.
Yeah.
Choose what you do with your own time. That's wealth.
I mean, I had this crazy conversation with a guy yesterday. I was traveling to meet with a client, and office called and asked me if I would take the call since they knew I was sitting in the airport. And so I said, sure. And this guy basically just wants to retire early. He doesn't want to own a home, and he just wants to travel. So he was going to go live in Costa Rica, and he'll be a bartender, and he wants to go live in some other place, and he can stay in hostels. And I was just, I'm thinking, okay, well, our financial planning software doesn't, we would just blow it up, right? But in my mind, it's like, man, this guy's wealthy. This guy's, he doesn't have debt. He does own a home that he can sell, and basically just wants to go kind of roam. That's what he wants to do.
Well, wealth can be, thought of as just simply having the resources that you need to do the things that you want to do, without having to commit your time to going out and getting additional resources to support that lifestyle. So, if 100,000 does it, or 1 million does it, or 10 million does it, all those people could be wealthy.
Absolutely. In the download, we break it down by year. These are Michaela here is a new planning associate with us. She did a great job putting this together, and she'll be on our next podcast when we talk about how to be financially successful in your 20s. She had some great points that she put down through here. She's going through the CFP process now, so she's starting to see the big picture. Mm-hmm. But we'll break this all down. Not every episode this quarter. We'll do it 20s. We'll talk about something else in your 20s, and then we'll go to 30s and add something else. I'm actually really looking forward to the 50s since we're just going to blow through life so fast this quarter. Because we're going to have Marty Paradise Consulting come in and talk about how to get your business to run without you, right? So I can't wait to hear that podcast.
That's an interesting idea.
Right? Marty's a guy that I send a lot of referrals to. Ironically, I've never actually used him as a business coach. He checks all the boxes, and I've just never pulled the plug with him. But I've interviewed him, and I think that's going to be a really fun episode for our business owners. So stay tuned for that. That'll probably be closer to, I don't have to ask producer Hadley here, probably you said October, probably November. Yeah, it'd be November. It is October now, I guess. So yeah, I mean, it's just different bits of wisdom, I guess. But it's all like rules of thumb. I mean, okay, so this is where you're supposed to be in your 40s or 50s, but there's always an exception, right? So people do that all the time. They say, oh, if I just withdraw 4%, I'm fine, right? Or if I can retire on 70% of my income, right? And these are all things that end up in Money Magazine.
Right, depends.
Yeah, it depends.
Depends is right. Yeah.
That's true. I had an attorney friend of mine that used to always answer questions like that. I would ask him a question, and he would say, well, it depends. I'm like, that doesn't help me.
Well, in each of these, we are referring to them as decades. Okay, the 20s, the 30s, the 40s, 50s,
right,
60s, and so on. But it's also intertwined with the type of lifestyle generally associated with those stations in life. Okay, so we're intertwining our age and our life circumstance as we go through this series, which I think is kind of interesting as well. So we'll bring a little bit of both into it.
I think it comes down to, and obviously I've read through all this and I know what we're saying, but if you just want to summarize, if you look back, you have a few more years to look back than I do, Brad.
Well, I've been through many of these decades, quite frankly.
But I think it comes down to, one is stay away from debt and don't chase the Joneses. Stay in your lane, do your thing, be happy, be content, and stay away from payments.
And that's really it. When you're into credit card payments, you're helping other people become wealthy.
Credit card, car, personal loans, student loans. These are all things that in the end steal your joy.
Yes.
And there's car payments because you got to get to work, but then there's unnecessary car payments.
Yes. And quite frankly, when I look back, in some of these decades, I can't remember what I drove. But at the time, it was very important to me that I drove that particular car.
That's true.
Or had that particular suit or that particular stereo or whatever the case may be. And I look back on this and,
was it really that important?
No, it really wasn't. There are things that are more important now and more important going forward than they were in the past, looking backwards. So, I think that's an interesting perspective. It's not that, we want to tell people what they can or can't do, but we just want to kind of share with them some of the best practices and best ideas so that they can, one, live their best life during that time period and take advantage of the freedoms that come with
that was
in your 20s. And
that was my point, is freedom. That's what you should be after, is not to be slave to a payment to where you hate your boss, you hate your job, you want to make changes, but you can't make changes because you got all these payments.
Right.
It doesn't make any sense. And I think starting in my 20s was probably easier than people starting their 20s today. One, housing. I think I bought my first condo right out of college. I think $2,000 down payment. I think it was around in that ballpark range.
That wouldn't surprise me.
Right. I mean, It was less, maybe a little over $100,000 for it. It wasn't super expensive. But today, man, I don't think you'd be hard pressed to find one for $300,000. Because you look at the housing market. Tom Townsend, he'll be back in this quarter talking about first-time home buyers. But I think to be in the vicinity of where the jobs are, you probably get $300,000 to $400,000 is what you're looking at.
easy. And I think that's going to be one of the big topics going forward for financial planning with the younger generation is housing.
Yeah. More people will be forced into renting who
Yeah.
don't have family support with that
Which
initial down
creates
payment.
what I call housing insecurity, because you don't know what that next year's payment's going to be.
Right.
Yeah.
Yeah. And we're getting more of that with younger children, parents coming in asking us saying, hey, we have this college thing going, but what about their start of life fund? And we never really thought about that in the South that much because it was pretty easy to get started here. But now we see parents starting to set aside money for kids when they graduate college to say, hey, here's 10, 20, $30,000 to help you get started.
Right. Financial planning is evolving with the times and taking, a look at the different things that are happening in the different life cycles that we're going through and their family members are going through.
I feel like 20s, it probably feels like it went by pretty quick, but I think when you're in the middle of it, I think your 20s are kind of slow. I think 30s is where it speeds up because that's a lot of times when you start seeing children born and your life just gets crazy busy. We think it does. And then those kids get older and have sports. then it spins faster than you ever thought.
Yeah. Well, I said you have to grow into it.
Yeah, exactly. Exactly. But I think it's, in the 30s, it's easy to kind of forget about all this. And you have to, when I say all this, I mean planning and insurance and all the basic stuff, right?
Right. And that's one of the things that we'll talk about when we get to that phase is that you're turning into a different station in life where all of a sudden all these responsibilities are coming at you so quickly that you didn't necessarily have when you were in your 20s. And so it feels a little overwhelming. But we want to talk about some simple steps that our listeners can take in order to check these things off one at a time, and begin to have a financial security and a plan that they can work with as they go through their 30s and move into their 40s.
Yeah, and then 50s, it's always hard to see people in their 50s who are just starting to save money because it's not about compounding anymore. It's about, that's when when you look back into your 20s, like, dang, if I just put 10% away, I'd be a multimillionaire right now. I don't care how much you made. So I think that's what a lot of this is about. If you can get the attention of younger people, there's so many ways to make your life easier going forward. I think, a lot of people that come in and use us as planners in their 20s typically are coming, I would say, out of more adversity, where
they come into money, through employment. The jobs that they have versus the jobs their parents have pay a lot more money.
I'd have to go through our project list and look, but if you look back, I think a lot of those kids, young adults, also had parents that were just really bad with money, and it just created a scar for them to going, okay, I don't want to be like my parents and not have anything, right? That's just what I've noticed. The ones that have kept spreadsheets and are really keep things really tight seem to come from that situation where the ones that were more free, they're not in here yet. They don't quite, they don't know yet. They're out living their best life because there's never been any friction, right?
Yes. And that is part of the point, that then all of a sudden when the 30s come along, they're overwhelmed with all this.
They start getting some friction.
Taken small steps in their 20s to gain the better traction in their 30s. So
yeah, absolutely.
Yeah.
Yeah. So anyway, we're looking forward to the agenda and the podcast this quarter, and the guests that we'll bring on in the process. So we hope our listeners find value in that. I think I think that covers what we're going to do this quarter fairly well. Last quarter we started off with a broken air conditioner. We got the air conditioner fixed now. It's great. We talked about that in our last podcast, but now I realize that the market's broken. So we got to fix that somehow during this next quarter, right?
We do have a lot on our plates.
We do have a lot on our plates, don't we? So yeah, I just drafted a letter to clients today. So when this posts, it would already been sent out. But, one of the things that we have to remember, you sent this to me, Brad, yesterday. The S&P is down about 22% year to date. We've got even the most conservative portfolios are down about 14, 15%. And that's really frustrating. From a business development standpoint, our firm has added just over, or will have added in the next few weeks, just over $50 million in new assets under management, which is 90% of our compensation comes from managing assets. About 10% and rapidly growing is hourly planning. But as a firm, we've moved sideways, and so we feel the same sting indirectly that that clients are feeling, because we get compensated based on what we're managing, and our growth of our firm is so much, and costs haven't gotten any cheaper. That's for sure.
And that's the big thing, in that we're in this sort of market and revenue streams, we're unable to offer new services, new plans, hire new people, because we are going sideways at the moment. So, we want the market to go up not only for our clients, primarily for our clients, but so that we can continue to serve our clients with the latest and greatest.
So then from a client perspective, you're looking at assets drop and you're thinking, man, can I stay retired, or I was about to retire? And you have to remember that when we look at these long-term charts of the stock market, that there's some really scary times in there. Was it 87? Was that Black Friday in 87, I believe? Black Monday. That's
October
right.
19th.
People were jumping off buildings because they were leveraged and they had no way to pay their debts back. But yet by the end of the year, the market was up. So it's, it's all in perspective, right? And first of all, you never borrow money to invest. And I don't know that our listeners would ever do that. Definitely none of our clients would do that. So you never want to borrow money to invest. You also want to make sure that as you're approaching retirement, you're debt free. That makes your cash flow a lot easier in retirement. It has nothing to do about rate of return. And you want to start building cash reserves, which our clients have. We know all this because of financial planning. We're a financial planning firm first before an asset management firm.
Right.
And that means everyone here has a financial plan in place, and every one of those plans, I'm very passionate about making sure that we stay in touch with our clients. So Tiffany here, who does our clients, is our client service manager. She has literally written up above her desk what percentage of clients have come in over the last 12 months. So right now we're sitting just over 85% of our client base has met with us to update their financial plan in the last 12 months. If you haven't been in the last 12 months, you haven't been listening, you need to come in, because that means we're losing touch. It's not because we're trying. You've been getting emails and phone calls every single quarter. I see them logged in. But ultimately, when we do financial planning, we take into account bear markets. We take into account the 2008 financial crisis happening all over again. And so we have a lot of confidence that you're going to be just fine. And we're talking to the masses, obviously, right now in a podcast. But when we drill down into a plan, there's not a plan that's going to leave this office that doesn't have a solution that's practical. And so we rest in confidence knowing that between your reserves, our reserves, if you're retired and already on an income stream, that it's going to stink. It's going to feel really bad. But, I was thinking about this as I wrote this letter, is that everything has a price. There's nothing for free, right? And so the price of long-term success is what? Market success. It's uncertainty. It's agony, if I can pronounce that right.
Yeah.
Right? It's did I make the right decision? So it could be regret. It could be a lot of things. Yeah. But that is the price that you have to pay in order to participate in long-term investing. This is not a get-rich-overnight kind of firm. We're not buying individual stocks. We're not buying mutual funds that promise to make money when the market goes down or if the market goes up. Those just don't work long-term. And so you have to remember that these are a little strange times. Jeremy Siegel has been all over. He's a Wharton management professor, or the Wharton School,
University of
economic professor. Now he is in bed with is it Wisdom Tree?
Wisdom Tree ETFs. He's an advisor there.
So I'm like, I don't know. He's been a little commercialized, but at the same time, he keeps talking about the Fed. The Fed is increased rates at a time when commodity prices across the board are actually decreasing. But when commodity prices were going up, they weren't doing anything. So everything that they're predicting about the 2022 economy in 2021 is now wrong. And everything they're probably predicting about the 2023 economy will likely be wrong, because we could be in a situation where early next year they have to stop raising rates and possibly even have to lower rates. So
the thing about the Fed is that they only have, they have very few arrows in their quiver, we'll say. And the major one happens to be interest rates, raising them or lowering them. And they tend to find, that one solution fits all problems.
Yeah.
Well, this problem that we're occurring, that we have in the economy today has several cross currents, but the Fed only has interest rates, raising and lowering interest rates in order to, solve whatever problem they deem, most important at this
that
time.
and buying back or
through the Treasury. Yeah.
Which they're tightening there too.
Yeah.
So it's really a double whammy. No one really talks about that.
No.
But whether Powell is right or wrong, it doesn't really matter. We're going to have to wade through it. In a lot of ways, it's a lot like flight planning. When you're a commercial airliner or anybody of a reputable air service, you look out there, and we know that there's going to be storms. We know there's going to be times just like this. And so what do? You have to pack on, even on a perfectly clear day, you got to add 45 minutes of fuel past your destination, right? If it's a really bad day, you have to have enough fuel to get to an alternate or maybe even a backup alternate. And that's just like it is with flight planning. So with financial planning, in that we know that we're going to need a first alternate, we're going to need a second alternate, and we know we have to have enough fuel to get to all those places plus 45 more minutes. And so we have all this. It doesn't mean that the ride is not bumpy. It doesn't mean that it's not a pleasant flight. It doesn't mean that as you take off, you're like, well, I hope this works out.
but when you land,
you're
sure glad it did.
Yes, when you land, you're sure glad that it did. And so you have to trust the plan. And for people who are just managing assets for a living, and their livelihood is telling their client, oh my gosh, hey, but we were down less than the market, or we were, whatever. To me, that business model is just dead, because a robot can manage assets these days. You don't need an asset manager. What you need is a financial planner that can navigate you through this, to keep you in line. Say, this is the plan. This is the plan, right? We can have some small deviations from the plan, but typically the plan has to be executed the way that it was drawn out. And the only way, there's no plan that's perfect. It's the plan that's less wrong, right? And the only way to be less wrong each time is to keep doing planning. So that's why it's so important to me that we have people coming in every 6 months to a year to update their plans, because each time we get to put in the new economic numbers and say, okay, based on what we know today,
right,
this works or this doesn't work.
And as you said, 85% of our clients have come in the past 12 months. And we've told them that we're confident the plan is sound. Okay?
Every single person that leaves
Which means
here.
when they left, they were confident
That's
that
right.
their plan is sound.
That's right.
So it's the 15% that we want to have come in and give them that confidence as well.
And quite...
Okay? And then as people need it and want to come back in,
right,
we can give them the confidence that it's going to be well.
And quite honestly, the last 4 plans that I've done personally, we actually shortened their retirement year by 1 year, or we added more revenue to their retirement because we know more. It's kind of like you're going to age 95, and every year that you plan, you get more right because you're closer to age 95. And at 94 and a half, I'm going to be 100% sure we can get to 95.
Right.
Right now, we're just 99% sure. So you have to stick with that. You have to understand that the price of investing has an emotional toll at times, but there are some action items that you can do, and it really depends on age. If you're retired, go be retired. Stop watching CNN. Stop watching CNBC. Stop Stop doing all these things, because that sensational news, they keep you attached to the TV talking about the COVID deaths, and they keep attached to the TV talking about the market fallout, because they have to give you something like that. They can't say, Mr. and Mrs. Jones, your retirement's going to be perfect, because the S&P 500 never let us down, right? It's or your pension's going to keep paying out. That's never on the news. It's only the ones that fail that end up on the news.
Mm-hmm.
And if you're pre-retirement, man, what an opportunity. What an opportunity. What an opportunity to save money, right? Because wages are still increasing. We are not really hearing anything in our client base of any job loss, job changes. If anything, they're making more money than they were a year ago. So this is a great opportunity to eliminate that, to be able to increase your payments, to max out 401k plans, to put extra money. We call it the opportunity fund. Put money into your opportunity fund, meaning it's not necessarily for retirement, but it's for something cool down the road. You just don't know what it is yet. This is a great opportunity to do that. And if you're fully invested, just make sure your dividends are buying more shares every time you get paid a dividend. Don't let those sit in cash.
Right. In a holistic financial plan such as ours, okay, the income that is being paid out to clients in retirement is a primary function of the plan itself. But what goes into that is all, much greater than the sum of the parts, because what happens is it maybe one year a full objective is to pay off credit cards or pay off a car or pay off a house. Okay. And then the next year that has come to fruition, and all of a sudden their plan changes.
Yep.
As you talked about paying off debt. Now we can take a look at, well, what does the income stream look like going forward versus the need? And maybe you can retire early. Okay, so it's not just the valuation of their IRA accounts and trust accounts and opportunity accounts, et cetera. It's the rest of their finances that impact how much money is required in retirement to live that lifestyle.
But it's creating that on a foundation. So that foundation is debt-free, money in reserve, and then you can go crazy on lifestyle expenses or whatever it is that you want to do with your time and money. But you still have to have that base established. And I think that base that probably doesn't get established until your 30s, because your wages are smaller in your 20s. But ultimately, what we're going through today in the market, it's almost like you have to get mad about it and take action, take advantage of the situation, because I just don't know, when is there a situation that fear always leads to the right thing? I don't
very often.
I don't.
Fear is not a plan.
I can't think of one.
No.
Is there a time in anything that fear leads to the right thing? I mean, I don't know. Maybe if you're like scared of your parents and you're a kid, you're afraid of getting in trouble, that keeps you out of trouble. Maybe. I don't know.
I think when a saber-toothed tiger was chasing the hominids way back then, fear probably worked out pretty well. But that may be the only case I can think of.
But I know in investing, fear, so to me, it's building a base, you don't build your financial base out of fear. You build it because you know that there's going to be times when you shouldn't be accessing market money because it's so volatile.
Right.
That's just a plan, just having a plan and a purpose.
Right.
So, it's something that we're working on developing internally. Other firms are doing this, not in the manner that I think is the best. But let me digress for a second. There's a book called Traction. It's part of the EOS business consulting service, or I can't remember the guy who started it because I haven't read all his books. I just read the Traction book, which, as a side note, is a kind of a combination of a lot of different business books. I didn't know you could do that. I didn't know you could read other people's business books and combine them into one and say you wrote a business book.
Yeah.
I would have written tons of business books by now. Just summarizing other people's business books. But in Traction, they talk about a one-page business plan. And so I have that. I have a one-page business plan for Wiser that just reminds me. It's all torn up and wrinkled because I carry it around with me. But it reminds me of, okay, these are the things, these are objectives, this is what we're trying to accomplish. Because, I'm an entrepreneur and I'm a gadget guy and, I've chased shiny objects, right? Well, we do that in life too. And so I think for our clients in 2023, I want to see us developing a 1-page personal financial plan that in the end, they have a client portal, they have 80-page report if they want to go through that. Nobody does, right? But I want to develop this 1-page financial plan to where people look down and go, this is my mission statement. These are my action items that I need to do now.
Right.
These are my long-term action items. This is a summary of my net worth, and this is a summary of, my big picture. And this is what I want in the future down at the bottom. And because we verbally as a team, we talk people through the process. And everyone leaves knowing that, but they still remember that. Because I don't think I would remember or recall quickly my mission statement, my business plan, if I wasn't written in front of me, right?
Right. And then each year in their annual review, that will start there, for example. And, step one. Step
what do we need
two,
to update here?
Update.
Yeah.
They come off, new ones go on, objectives
Right.
for the next 3 months, 6 months, 9 months, and 12 months.
I have the vision for that, and we're going to start work on putting that together this quarter. But I say all that because you have to have a purpose. You have to have goals. Even if your goal is to do nothing, that's still a goal. I want to sit on my couch. I want to watch TV. That's your goal. That's your goal, right? Or I want my grandkids to have a better life than I had, or maybe even my kids had. And this is how I think I can help them accomplish that. Or I want to invest this time in my spouse because we're disconnected and we need to make sure we're moving in the right direction. So writing those things down and waking up every morning with that purpose, this market stuff becomes less scary, right? Because you know that there's going to be a storm, but you know what? You're just going to keep killing it every single day. And I think that's my reminder to everyone is like, wake up, do your thing, keep killing it every single day. The market thing's going to take care of itself. It always does. It always has, right? Just we're invested in core index funds. There's nothing crazy going on over here. But what you can't do is get so emotional that you just check out and you start liquidating stuff and saying this is terrible. And,
I think sometimes investors forget that, in times like this, it's when business managers hone their skills and they get better and better and better at allocating capital within their business to make sure that they're getting the most efficient and highest productivity out of each dollar invested in their own businesses. And then when the economy changes and turns around and market begins to go back up, they're in an even better position they were than when they went into that same circumstance. So it's these times that make business managers even better, which means investors have an even higher opportunity for wealth producing gains.
you just have to remember, going back to my example earlier, there's rich people and there's wealthy people. Wealth is hidden. You can't see it. There's a lot of rich people driving really fancy cars. There's a lot of wealthy people driving Hondas and Toyotas and basic Fords, right? Can't say Ford trucks anymore. They're ridiculously expensive. But, but you just have to remember that we can't judge ourselves looking at other people. We have to look at our situation. There's a lot of people in big homes and fancy cars that you're going to have a much better retirement than, because they're not thinking about any of that in the future, right? They'll just go and talk about one day they had, or they'll just work till they're dead.
Yeah. Yeah.
So, looking forward to it, Brad. I guess we'll have to call this podcast a market update, Hadley, because that was pretty in depth. But bottom line here is, guys, there's nothing to panic about because there's a plan.
There's a plan in place.
And this plan for this. So keep living your life, keep saving if you can, save more if you can after you've eliminated your debt, and you're going to be fine. It's going to be fine.
Yes, it is. History shows us that. Shows us that.
Every single time. It's just when you're walking through it, it's just frustrating from as much as we watch this stuff, and
yes,
sometimes there's a rhyme and reason behind it, and other times you just kind of shake your head going, I don't get it. We're getting close to that number.
We are, which means it's getting close to that other number.
That's true.
That's when the time
begins
to go up. Again.
That's true.
Okay.
All right, Brad.
Very
Talk
good.
to you next time.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.